Today in Castoshi, I talked to Noah Healy of Coordisc. Now, I'm warning you that this episode is quite technical, so you have been forewarned. Noah is a mathematician who has developed a new technique to provide high price stability for crypto markets and uses game theory to reward traders for predicting asset prices. To give you an example of how this could make your life easier is to think about when you buy or sell a token on an exchange and it gives you a pop-up with a 5-second countdown with which to accept or reject the trade. Well, with Noah's system, you will have not seconds to accept the price, but potentially minutes or even hours. We have a great discussion and also talk about the multi-chain future of blockchains, and enjoy the episode. Welcome to another episode of Castoshi, and today we speak to Noah Healy, a mathematician and market designer. So, welcome, Noah. Could you tell us a bit about yourself, please, and your project?
Yeah, sure. Thanks for having me here. So my primary project is something that I call coordinated discovery markets. It's an alternative form of price discovery for financial marketplaces, primarily commodity markets, systems that have disjoint groups of supply and demand. And it works by linking a dark pool like clearance to a independent price discovery mechanism of a forecasting market uh, to produce a complete marketplace that can operate at sort of human scales and speeds, um, at simpler regulatory expense, lower overhead costs from transactions, and considerable savings in computation requirements.
Okay, so it sounded very technical. Um, so we'll dive into the benefits a bit later. Um, could you tell us a bit about yourself and how your background and how you got here?
Sure. So I'm, as I said, a recreational mathematician. I've been interested in math more or less since I've been exposed to it. And one of the things I really love about mathematics is its incredible breadth, but at the same time, how the entire system essentially connects. So techniques from one branch of mathematics give us benefits in other branches. And that is at the core of this innovation. I've discovered a strategic situation in game theory that I call negotiation games, that essentially allows the specification of an extra player to be operated by a computer program with no volition of its own to add to a coordination game that allows the coordination game to behave in ways that are of greater advantage to the people engaged in that game. Uh,
Could I ask you what you mean by cook? Because a lot of the ideas are very technical, and I need to make sure that I dumb it down a bit
sure.
for not just for my audience, but for me more than them. So could you, when you say coordination game, could you define that? Because I'm trying to get
Right.
to what the
So
benefits of the system are.
a coordination game is a game in which deviating from consensus harms the deviator. A natural coordination game that many people play every day is, what side of the street do I drive on?
Mm.
Um, there are rational arguments for driving on the left, there's rational arguments for driving on the right.
Mm.
If you live in a place where everyone kind of randomly picks in the morning, traffic works a lot worse than if you live in a place where everyone just picks one and everybody does that. Um, if you're in a place where everybody drives on one side of the street and you deviate, you're probably going to make some other people's lives worse, but you're definitely going to make your life worse. And so coordination games have this, they're also sometimes called stagnation games because when you play them in a repetitive fashion, people tend to just do what they've been doing. because innovation harms the innovator, even if general adoption of that innovation would be beneficial to the group as a whole. Um, and so uh, these kinds of systems show up all over the place in the natural world and in the financial world and marketplaces, particularly marketplaces that are attempting to balance supply and demand for disparate businesses are a natural coordination game. Um, if you're a farmer or factory owner or miner or some other person engaged in commerce and you want to break out of the price system, um, then you're going to harm yourself. If you attempt to sell for more than the market will bear, then you will find that you find have no customers and will lose your revenue and go bankrupt. If you attempt to sell for less than the market will bear, you will find, because it's a competitive space and you have low margins, that you are bankrupt yourself because you're paying people to take value from you, and that's not going to work out very well. The On the buy side, you have sort of the reverse problem. If you want to buy for too much, then you're going to suffer at the hands of your competitors, and if you want to buy for too little, you're going to suffer at the hands of your suppliers because they're not going to pay sell you anything. Um, so, in environments like this, with competitive buyers and sellers on each side, there's a compelling interest in discovering what the joint consensus of the entire group is. And that's why financial markets even exist in the first place. Uh, that service is valuable, as demonstrated by the fact that financial markets make money. For large markets, they make large amounts of money because the bigger the market is, the more it's worth. Um, what this system does, which no previous system has ever been able to do, is it separates the cost of the marketplace from the rate of return for the sort of information providers in the marketplace. We usually refer to these people as informed speculators these days. Um, Warren Buffett is globally famous for putting together a few decades of 30% returns. Um, in general, uh, most people in this space would be pretty happy with sort of 10 to 20% returns. In fact, most of them would be ecstatic with 20% returns. Um, but to increase the general rate of return for the that industry as a whole, the costs of the marketplace itself would have to go up. And the higher the cost of service is, the lower the value the service has, um, because cost is part of the system. If somebody can do something for you that makes you $100, then if they're charging $10, that's great. And if they're charging $200, then you're not going to go there anymore. What my system does by separating the forecasting or speculative information provision from the costs of trade allows essentially striping information across the entire marketplace, which effectively gives every individual forecaster access to the leverage of the entire marketplace, regardless of their size. And so, through a parimutuel system, we can actually set the average rate of return within the market as a parameter. And then, by setting that parameter to be significantly higher than the current average rate of return, you create a market that's more attractive for informed players to enter.
Okay, are you saying so? For example, if there's a large institutional buyer and they want to buy, say, Bitcoin, if they go into the market and they want to buy like $10 billion of Bitcoin. At the moment, what they'll do is they'll go to a brokerage and say, "Could you buy me $10 billion over the next, like, say, 4 months?" And they will dollar cost average that buy. But would this system allow them to? And the reason they do that is so they don't move the market in like double the price of Bitcoin.
Right.
Does
Yes.
this
So
system
that's
prevent that, or?
uh, yes. So this stabilizes that marketplace. So you have a desire to own $10 billion worth of Bitcoin, say. Um, the market reacts to those sorts of things. That's its job, more or less. And every market needs to react to that sort of thing. The way my system functions is that the people who want to buy, the people who want to sell, would are essentially negotiating the future on an ongoing basis, and then as the future turns into the present, they are determining how much they wish to buy and sell. So people who want to make a large scale purchase um, are essentially adding new demand to the marketplace. And so what they need to do is raise the price of the marketplace um, in order to stimulate more supply so that there'll be some supply there for them as they're buying. Um, the the difference, as it were, is that because the market is offering a stable flat price across the entire market to everybody, what they do not incur is the existing market risk, which is personalized. What the existing market offers is personalized buy and sell experiences. And that means that because of the sophistication enabled by modern computer technology, effectively the middlemen can put these sort of large end users into bubbles. And so to a lesser extent, you know, if you were setting yourself up as a mark, you know, like, hey, I've got $10 billion, I want to buy Bitcoin. Um, a sort of canny investor could see that, front run your action, essentially drive the price of Bitcoin to the sky, um, sell you a couple of Bitcoin for your $10 billion, and then instantaneously crash the marketplace because there isn't a large order in place anymore. Um, and that's why right now you would have to pay a broker to mask what you're doing. Um, but the need to deceive the marketplace in order to use the marketplace is itself a source of noise in the marketplace,
Mm.
which diminishes the value of having the market. Um, if your accurate desire for Bitcoin isn't actually reflected in the market, then the value of the Bitcoin that you actually acquire will be undervalued as well. So the in any market where accurate information is of paramount importance, which is, you know, basically every market that's not a Ponzi scheme. Um, having a system that is stably truth centered will benefit the participants over uh, a sort of unstable marketplace.
Okay, so as I understand it, so just so I've got $10 billion. I go to a company like just say Coinbase who's implemented this. I assume it's an automated algorithm of some sort, and I say I want to buy 10 billion and like dollars of Bitcoin in the next, and I assume I have to give it a time range.
So the way this would work is that a implementer, let's say Coinbase decided to implement this, would set up a schedule of trading. So let's say daily trades would be enabled. So what they would have is they would publish for every day into the effectively indefinite future what the forecasting market's projections of the Bitcoin to dollar price look like. So once a few cycles of that had gone by and it had stabilized, you wouldn't essentially go to them and say, "Hey, I'm in this position. I'm interested in this." What you would do is you would look at their publication and say, "Okay, they say that Bitcoin is, and I'll just make up some numbers, um, $1,000 per this week, and running up over the course of the next 6 months to $2,000 a piece. Um, and so you would just look at that and say, okay, well, those numbers look fine to me. I want at $1,000, 10 billion. I want 10 million Bitcoin. And what the system would do at the end of that day is take the buy sides and the sell sides, settle them off against each other as well as it could, and make whatever exchanges were enabled. In the case where you're an anomalous new player entering with no foreknowledge, it's quite likely that the vast majority of your desires wouldn't settle. Um, but people would now see that the market was heavily out of balance because somebody wants Bitcoin that's not getting it. And so there would be some cyclic negotiation of where the market would have to get to so that supply would sort of balance with demand. And that number would, at worst, equal the amount that you would have to pay to a brokerage, because it has more information behind it and more liquidity behind it because it's an entire marketplace instead of just one brokerage. The prices that you would wind up having to pay to a sort of bespoke system. And that's fully symmetric on all sides. So somebody that has millions of Bitcoin that they wish to liquidate would have exactly the same kind of experience, but just sort of, reverse polarity.
Okay, so in a way, it's kind of like an automated market maker, but a very sophisticated one. Is that a correct analysis?
Yes. So it's an automated market maker that is capable of integrating um, opinions and data from multiple sources. And so the way it works is, rather than having sort of the existing automated market maker system of having some fixed algorithm based around, however you've set the marketplace up, what this thing does is it takes on board the opinions of all players within the marketplace, integrates them into a unified sort of supermind, and then, using information measurement and parimutuel strategies, pays off those individuals based on how useful their contributions were to this sort of supermind. And then every actual trader gets to take full advantage of that price knowledge in their trades.
Okay, so in a way, it has to also do some prediction of the price as well.
Uh, what it's doing is it's integrating other people's prediction of pricing.
Okay,
So,
okay, I see. Yeah, yeah. Okay. And who would look? And if this, just say Coinbase, I'm not sure where you are with this. How far you've taken it, but just say Coinbase came to you tomorrow and said, "Okay, we're going to integrate this." Who would lose out?
the primary losers are the existing sort of deep pocketed hedge providers in the marketplace.
Okay, because
Right.
if I go to Coinbase, I can elect to be a market maker myself. So I would be the one. I wouldn't be able to do that anymore. Is that what you're
You
saying?
wouldn't really, yeah. Since you could attempt to sort of day trade against this sort of market, but
Mm.
since it's already operating with this forecasting market, which has the aggregated
Yeah.
knowledge of sort of everybody, um, it's significantly harder to correctly outbid everyone. And
Mm.
the rates of return that you would enjoy for sort of joining the crowd and providing your information to the system and then being rewarded by the system
Mm.
for, being correct, are significantly higher than the rates of return you that anybody actually achieves by attempting to go out and market make themselves right now.
So there's a kind of futures aspect to it that I have to kind of say what my price is that I think it makes sense to buy or sell at.
Yes.
Yeah,
But the trick is you're not saying what your price is necessarily. You're saying where you believe market price will go.
sure, sure. Okay, and how would it work in a situation? Because when you've got a liquid market, everything's, like, I remember when buying and selling Bitcoin on exchanges was sometimes like nearly 20% commission, and spreads could be even bigger. I mean, I've and today, if you use a lot of like alternative, like altcoins, you might see a price, and when you actually buy or sell it, even today, you can be paying double the price or triple the price if you buy it, and if you sell it, you might get less than half the price for low liquidity tokens. How would this? And I think this is one of the real pain, because I think you're right in that it would be nice to have a more even price for, like, say, big buyers who want to buy Bitcoin, but I think one of the biggest pain points I see in the market is for low liquidity coins. So how would this be useful there, or is it only for something with liquidity?
So the thing to understand is that the information and knowledge comes from the forecasters.
Hmm.
This doesn't sort of guarantee exchange. It just rewards forecasters to the extent that exchanges occur. So it can scale down to lower liquidity situations, but what you would want to do in those circumstances is slow down the pace of exchange to give sort of more time to have things that are interesting enough to go on.
Okay.
The So rather than maybe a daily type of exchange, you might have a weekly or a monthly type of exchange. The other consideration that's kind of important is that for very low liquidity types of marketplaces, there are very few actual players in the marketplace. So once the number of players gets small enough, individually talking to each other is more efficient than using a marketplace. Um, and this system does not scale down to that stage. So it's sort of less about liquidity and more about number of people interested. And for that, the number's about 50. So if you don't have roughly evenly split supply and demand interest, um, with a couple of dozen-ish people on each side, sort of minimum, then sort of Rolodexes become a better idea than a marketplace. But once you get sort of over the threshold of marketplaces are a decent idea, then this offers a marketplace that costs significantly less.
Okay, so what I'm understanding is the people who benefit from this is people who are buying or selling large amounts of something, not
Um,
small amounts, really.
small amounts in aggregate actually also benefit from this. And in fact, one of the features of the settlement is that um, you generally want to settle bottom up, so that small players get their orders filled first, um, or everyone gets their order filled at the same rate, but small player orders run out first, and so they get fully filled. And what that does is actually increases competitiveness within the marketplace, which is in the market operator's interest. Market operators don't like monopolies because a monopolist or a monopsonist can dictate terms to the marketplace, and nobody really has any choices in the matter.
Okay, so you're saying that as long as there's liquidity, it can give a more. I'm trying to think that of the benefit. Is the benefit that I'll basically get a more even price whether I'm buying or selling?
Exactly. Yes. So uh, there are essentially two forms of price risk that we tend to aggregate together. There's actual future uncertainty risk, which humanity can do the best we can do, but
Mm.
that's only as good as whatever it is. And then there's market risk, where the structure of how a market does exchange can lead to intrinsic instability. And that's the kind of thing you were talking about, where there's a posted price and you go and say, okay, give me, you know, $10 billion worth. And they're like, whoa, yeah, that was the sucker price. If you
Mm,
want like real numbers, we gotta jack it up a bunch.
mm.
Um, what this does is create a system where everybody engaged in the system makes more money the more they reduce market risk.
Also, there's no
Where
sucker price. I understand that.
Yes,
Having been a sucker many times myself.
yes.
Okay. And what happens if, so just say Coinbase implements this and suddenly the value of Bitcoin starts to um, even out on Coinbase, but on other exchanges it's more like it's jumping up and down more. That's going to, isn't that going to mean that you're going to get a lot of arbitrage opportunities because then people will be jumping between, because it will still have a different price. So so people could start to use, say, Coinbase's price as a kind of barometer of where the price should be.
And in fact, they should do that, because since it's this sort of accurately integrated, wide scale opinion that's more
Mm,
accurate than individual
mm,
opinions, um, in a market to market competition between a market based on CDM and a market based on sort of
mm,
more traditional properties, bidding the CDM's beliefs into that other market will,
mm,
on average, drain liquidity from that marketplace. So just as with existing markets,
mm,
a high liquidity market will have a tendency to eat a low liquidity market,
mm,
because bidding the high liquidity markets pricing information into the low liquidity
mm,
market will allow you to beat the market makers
mm,
there. Bidding a CDM's information into a existing market design
mm,
will tend to take money out of the pockets of the market makers there,
mm.
to the point where eventually they'll have a choice between, bankruptcy or discontinuing operations.
Okay, okay. I think I understand that. Okay. So, okay. Has anyone tried this before?
Not yet. I've got a few irons in the fire right now, and we're working towards getting one of these things up and running. But
Mm,
there's nothing in the historical record. Uh, nobody nobody has published anything which has survived, which suggests this is an idea for how to operate a financial system.
okay, because I'll admit, I mean, I can see Wales might want to use it, but I can't see why someone who only wants to buy, like, if someone wants to buy like half a Bitcoin, they don't really care if they pay 32 or $31,000. But if someone's making a bigger buy, they do care a lot more, I think.
Yes, certainly people who are making larger trades care more uh, about those trades than people making smaller trades. But I would dispute the concept that people might not care about $1,000 just because that it's all they've got. Um, people negotiate the prices of cars. People care even in the small cases. And again, the greater degree to which the small player or the retail player can be operating closer to reality,
Mm,
the better they can operate their own systems. So it's in the concerted interest of the small player as
mm.
well, because they too are going to be able to take advantage of this better pricing.
Okay, so would this let me do, for example, if I go to Binance or Coinbase and I put a buy in for something, then a pop-up box comes and says you have 5 seconds to say yes or no. With this system, would it? I mean, would it change and say, okay, you have 1 hour to say yes or no?
Effectively, yes. So the way this would work is that your desire to supply or demand, you were talking about making a buy. So so that would be,
mm,
demand side, would get aggregated with other people's desire to do the
mm,
same thing. And so a sort of joint buy, joint sell
mm,
occurs, and you get this pool style exchange rather than just your one off. So there would be a window that was essentially open, and during the time of that window, the prices would have been at the pre-negotiated
mm,
set amounts. And if you wanted to kind of open your account up and say this is how much I want to sell, and then like eat a sandwich while you're looking at that
mm,
and see how you feel about it afterwards, up until the end point happens, you haven't committed. If you've got a commitment in and the end point's passed, then you're part of the group, and sort of whatever the algorithm says, you'll be buying as much as you wanted to buy, but never any more than that,
mm.
maybe less, or selling as much as you wanted to sell, never any more than that, but maybe less. And just it would be whatever the general desires of the aggregate turned out to work out to.
Okay, I always like to test these things with like a stress test. For example, like if you look at what happened with Terra and Luna. So if, for example, well, I think with a lot of in stock markets and crypto markets, that most of the huge falls are because people are getting margin called. So what happens then if people have put in buys and sells to buy Bitcoin at a certain price, um, and then suddenly the price tanks because a lot of people get margin, some big player gets margin called or there's an attack, and then the price drops like 20%, like in minutes. What happens
So
to the people in the pool who've not really done anything wrong, but suddenly they're massively wrong in the case of a few minutes?
so the key there is this forecast price discovery curve, where people are putting in their opinions of where prices are heading in the future.
Mm,
One of the major issues with using markets of current design for things that are intended to be currencies like Bitcoin and Luna and
mm,
so on, is that currencies have a bubblish character to them in terms of their value.
mm,
And that means that there's a tendency for the sort of margin based markets to overvalue them, overvalue them, overvalue them, and then crash. Uh, what this system does is by forcing people to declare essentially as far into the future as they're willing to,
mm,
confidently state what the value curve looks like.
mm,
What you get is a situation where bubblish price
mm,
changes um, become sort of obvious money taking opportunities.
mm,
And instead of having a marketplace that's sort of based around bubbling and crashing, what you have is a marketplace that is much more around a pre negotiated, stable move into the future. Um,
okay.
and so that essentially cuts those sorts of situations off at the pass, as it were, because the kind of hyperinflationary froth followed by, depressive crash, are each, if they're sort of seen in the future, then the lucrative opportunity to sort of find that middle ground where neither of those things happen, becomes public knowledge. And so everybody that wants to make any money just fixes the problem.
Okay. Yeah, because I'd interviewed someone called Sam Kamani in a previous episode, and he's made something called Insider. That's ENSYDR.com. And what he's trying to do there is he was trying to get people to predict prices, at a future date. And and I'm not sure if he was going to use that for trading or doing something with the market. But it seems like a very similar concept, except I think what you're trying to say is it's not just prediction; it actually affects the like the people making the predictions. Um, well, I'm guessing that you're saying they'll get rewarded somehow.
Yes. So what the market does is when it makes exchanges, it takes a commission for the exchanges that it's making.
Mm,
It can take that commission and split it between the market operator and the parimutuel pool of
mm,
forecasters. And so the forecasters get to live in this positive sum game
mm,
where money's coming in based on how well the prices that they're predicting
mm.
attract economic exchange.
Okay, okay, I see. So in a way, it's kind of like a new type of futures exchange in a way.
Exactly.
Okay,
It's a brand new futures exchange built on this new kind
okay,
of game theory model.
okay. And how did you get here? I know you've been a mathematician for some time, and what was your previous work that's led you here?
So I've been working mostly in back office software for .com startups. What got me here was thinking about the computational theory of networked communication and specifically consensus formation in networked communication. And that's what got me into these coordination games ideas where a consensus is a coordination game where deviating from the consensus harms the deviator. And so then developing this idea of how to turn a coordination game into what I call a negotiation game with this extra computer program that sort of mediates play, um, to help people sort of get out of bad ruts and into better ones. Um, I then was sort of, pushed into thinking about marketplaces and more or less as a lark, decided to figure out whether or not this approach could be applied to marketplaces. And once I solved that problem and found a computer program that would do that, that's this coordinated discovery market idea. Um, uh, Analysis of that system determined that it had all of these very positive properties, and the detrimental side of things, the fact that it doesn't scale down, quite as far as regular marketplaces.
Okay,
Um,
so this was a problem you actually had. You'd seen firsthand in the .com companies you'd worked in.
Not really. Like I said, I'm a recreational mathematician. I there are shades of that. Large companies' internal communication networks are very bad, and so having better communication techniques for large companies, or rapidly growing
Mm,
companies, which I have more experience with, are useful. But this was mostly sort of a sabbatical that I had taken to see if I could have some fun thinking deeply about computational mathematics. And while I was
mm.
doing that, this is what happened.
So in a way, I mean, I'd mentioned this insider company earlier. So it's possible that that if you actually had your own website to, and people entered their price predictions, you could. I think like what Insider does is they reward them based on how close they are. But you could do that, like for example, with your own token or with dollars, because you could trade on that knowledge as well, and I mean, you could use it to actually trade yourself.
I could. I don't have much interest in that, but a couple of the projects that I'm sort of consulting for right now are thinking about that in terms of my technology. And then
Okay.
the other one is thinking about index building and setting up uh, some form of commissioning around an index-based exchange.
Okay, I guess that's taking me to the next question, and is basically, so what is the current setup? So you built this and you've tested it, or what's the current status of where you are?
So I am pursuing the patent inside the United States. It's open source outside the United States. I have written code that will do what the algorithm, what is demanded of the algorithm,
Mm,
and done load testing on that code.
mm,
Um, the computer I'm speaking to you on would be capable of performing the settlement and integration functions
mm,
for really the entire global set of commodity markets.
mm.
Um, the algorithm is significantly more efficient than sort of the existing quick trading systems that we use.
Okay, so what's
Uh,
it written in, by the way?
uh, it was just some quick and dirty Perl. It's about
Oh, okay,
300.
cool.
The key parts of it are only about 300 lines long.
Okay, so it's the actual algorithm itself is special. It doesn't have to run at trillion operations a second. And
Exactly.
okay,
Yes.
okay, okay. Um, so you're are you like I'm guessing that you're taking like, how are you testing this? Because is there any prediction, any data for people predicting prices compared to the actual prices? Is that available? I guess with
Um,
futures markets, it should be somewhere.
for futures markets, there's a little bit. It's rather difficult to test, and unfortunately, that leads to sort of the chicken and egg. That's why there's kind of only a handful of projects that are
Mm,
in sort of early stage of getting off the
mm,
ground. Um, Ultimately, it tests itself based on whether or not the predictions actually lead to trade. So
mm,
if a prediction market sets itself up and nobody actually wants to trade at the prices it's predicting, then that extra income doesn't get produced, and the forecasters aren't going to get the sorts of returns they were looking for because there's no market space there. But ultimately, yeah, sort of some project somewhere is going to need to warm up enough to get a first thing off the ground. At which point, then I will have a demo
mm,
and the sort of intra-market competition should
mm.
carry on from there.
Yeah, I mean, I'll admit, I keep meaning to for the last year build a system which will take like the last 12 years of crypto data and run my predictions over them, and I've only got around to building very basic versions. I mean, I'm guessing one way you could test it though is you could literally have like, say, 50 bots as market makers, and they just give a random price, and then based on what price they say, and whether they're like, you could look at the real Bitcoin price, and these bots could just give a random price each, and then based on how well they do, you could upgrade them or downgrade them, and maybe the bots themselves could learn. You could run it through AI and have it
Well,
learn.
from that perspective, actually, I have written uh, to deal with businessmen mostly in Excel, but I have written a very simple Excel model of where you know uh, there's about 40 buyers and sellers. Each one of them
Mm,
has their own personalized uh, supply and demand curve,
mm,
and then each one makes a guess about where they believe the market is headed,
mm,
and you can do sort of a straightforward integration pass
mm,
on that with a comparison, and so I can demonstrate that kind of middle narrowing that's baseline. And the key is that the edge users actually have all of the information required to come up with a settlement price,
mm,
because the edge users are the people whose price needs are being met.
mm,
And so because of how the integration algorithm works, even if people have a generally very bad idea of how the market works, as long as they have a generally pretty decent idea of what their own opinions are,
Mm.
the the various bad ideas about the marketplace will tend to average out. And so when you integrate their beliefs together, what you wind up with is the a relatively small noise component
Mm.
of the canceled out,
Mm.
random bad beliefs about the market, along with a very, very strong signal component of whatever their whatever the aggregate value of all of their personal interests were. And in an environment where once that's been done and traded on, it's all still there because you were, forecasting the
Mm.
future. So you can now see that and update that.
Mm.
um, People can now, with this much better idea of where the marketplace is going, update that based on their own personal understanding. And so what you get is a incredibly rapid convergence towards a negotiated settlement that is the common interest of
Mm.
all the participants.
Okay. I mean, it sounds like an ideal system if it worked for people buying and selling. I mean, once you've been able to test it with data or real world, or with someone who's actually using it, it would be interesting to
That's
look at it again.
yes, that's definitely
Yeah.
that's the chicken and egg. The math is absolutely solid. Simulations are relatively easy to put together,
Mm.
and again, because the math is absolutely solid, the simulations work more
Okay.
or less perfectly. But actual humans actually doing it, somebody's going to have to go first.
Sure. Sure. Okay. Okay. So I think the other thing I'd like to talk about. I mean, I understand what you're doing then, and understand the product, and so where are you in, for example, in the crypto markets? Like, have you been involved with them yourself, buying, selling, trading, or building smart contracts? What's your involvement there?
I've consulted with people who are building marketplaces,
Mm.
and I've developed this technique I call the story matrix
Mm.
that allows people to essentially uh, kind of translate their ideas about their users and interlocutors
Mm.
in a way that can then be assembled into a game theory matrix, which can then be analyzed for holes and edge cases and so on.
Are you talking about token design? For example, when people make tokens, or like for example, like with the Phantom blockchain, there's a lot of these things called tomb forks, where there's a whole DeFi community, and they're basically pegging assets, and it's a bit like the Terra Luna thing, but not based on the US dollar, based on other token values. So is it that sort of thing, or is it like, for example,
yes,
something like Gitcoin, where people can?
one of my three irons in the fire is a team that's doing something much like that.
Ah, okay, okay, I see. Yeah, because the thing is, I think one of the things people have learned with this Terra Luna thing is, I mean, I can remember like a couple of weeks before it went down, and people wouldn't believe me that it's possible it could fail because most people never actually looked at how the mechanism worked, and I'd looked at it, and I saw, yeah, it could become massive, but it could fail for sure. Um, and I think the mechanics of how these ecosystems work, like there's so many, like, I think with crypto there's so many ways they can fail and very few ways to get them right. That's one of the problems. And if you do have to fix a problem, you basically lose all your decentralization.
Decentralization is, yes, a major challenge to most of these things, and that's where uh, game theory approaches, where you can create incentives to
Mm.
avoid failure cases, um,
Mm.
in theory, is a good approach.
yeah, but because I think a lot of people, I mean, because some of these things, like prediction markets that you talked about, you can actually test some of those with bots to a limited extent. But some of the things are only really testable because it's so human. For example, like if you look at tomb forks, for example, people, everyone wants to, like a lot of people just follow whatever's paying the highest yield. But then you get a lot of insiders who just follow what the whales are doing, and there's all of these like different actors, and at the end of the day, no, very few of them have the complete information and know what's actually happening in the market. So, some of the token economics, I don't think they're even designed that that everyone can win, because some of them can't get part. And this is something with crypto, is some of these things just cannot survive on the way down. Most of
Right.
these systems only can survive if there's a bag holder at the top, and I think that's one of the. I'm saying this because I'm designing my own token, and the main thing I have to model is what happens when everything goes down, because I want it to be utility that works even if there's only one person using it, and there's a network effect that that it doesn't it's not about pumping a price up, that people get value which is not linked just to the price.
Yeah. Well, that's admirable, and that's basically necessary in order to create an economic system that isn't just going to sort of collapse at the first whisper. The internet itself sort of demonstrates this. The early days of the internet, um, security essentially wasn't a concern because the DoD was sort of setting all these things up inside its own offices, and the notion of sort of skilled black hats blowing things up for the hell of it did not occur to them as a standard problem set. And so there was sort of the first mass internet virus outages from like email worms and stuff like that. And then people kind of figured out that you can't just accept any data packet from a random unknowable system and execute whatever it tells you to execute.
Mm.
Uh, you gotta be a little bit more discerning than that.
Yeah, I agree with that. I mean, I think one difference with the internet is, with the internet, I had this conversation with someone in another episode, is like, I always thought that DeFi and smart contracts would never work, because I thought that, well, as a developer, I know that I write a lot of bugs every day, and but the difference is in most companies, when you write bad code, like when you write something bad, or or as you said, it was run within the DoD, and like most bugs, they'll never see the light of day, and they'll do a human workaround, and it might take 20 years or never to surface. You know, so like with the internet, I mean, the internet might not have even got to where it got to if that security had been built in. And there was other secure networking systems which the internet beat.
Right.
Um, so, but I mean, the thing that I didn't realize about that happens with DeFi is DeFi. I think one of the in crypto and smart contracts, one of the big differences between, like, I know it's compared a lot to the early internet, but I think one of the big differences, it's kind of like a world in a bottle. And like what might take 50 years to develop over the internet, from the late 60s to 2020, what's how 50 something years, in
Right.
smart contracts can literally happen in a week. And so you have this accelerated time. And so some people might say, don't people know how to write code? People do know how to write code, but to try and do in 1 week what people have taken 50 years to build, because because the internet's, so many pieces of the internet have been tried and tested, and over many years, and suddenly someone writes a DeFi protocol and it gets hacked on the first day, and people say, oh, that's a really bad coder. It's like, no, that's just normal. The internet's had
Right.
years. I can't remember what the point was there, but I think it was about how you do token design. And I mean, I've seen so many systems which have seemingly fantastic designs, and and then um, I mean, there could be a bug in the code, like re-entrancy bug, if it's a smart contract, or it could be a design in the logic, or it could be an actual like attack which no one thought of. There's so many ways they can fail. So I guess you've seen all of this.
I've seen some of those things. One of the things that can help is by reducing complexity to sort of sub-Turing levels. So simpler systems actually can be fully analyzed,
Mm.
um, whereas unfortunately the the simplicity dividing line between fully analyzable and not fully analyzable is much lower than people generally, realize. Um, and so, for convenience, most people just go ahead and take sort of full computability into their systems, and that leads to a large classes of bugs, basically.
Yeah, and it doesn't help that the code's all public as well in smart contracts.
Well, I think that actually might contribute towards that acceleration you were talking about,
Mm.
where with the code all being public, there's that open source many eyes type thing. There's a lot
Mm.
more opportunity to kind of see what doesn't work and try to avoid it at least.
I think what's going to be scary is when something gets to like a $5 trillion market cap, I think it will at some point. Something will, and suddenly there's a hack. Like you imagine if Luna Terra had got to 2 trillion market cap, which was possible. It was very possible it could have happened, and then somehow it got attacked and the money was drained. I mean, like, and you talked about complexity. I mean, the complexity of the different blockchains and things like Cosmos and inter-blockchain communication and assets being locked on one chain and used on another, it's got so complex that there's entirely new categories of bugs that people haven't even discovered yet.
Yeah, yeah. My general opinion on blockchains is that um, they aren't really fully cooked as a technology yet. That they are an impressive idea, and we're getting some utility from them. Uh, but just as sort of one simple and generally well-known example, uh, chains have a hash dependency where if the hash breaks, the chain breaks.
Mm,
And we don't currently know what the strength capacity of our hashing functions are.
mm,
So, you know, maybe somebody could open up a paper next Tuesday. I mean, it's very low
mm,
probability, and discover that all these hashes got broken by some new breakthrough by some
mm.
prodigy in Cambridge, and that's the end of that story.
I think that's why
um,
some quantum encryption and stuff like that is. I mean, people are trying to make it resistant to that sort of.
that Yeah, yeah. One approach which I haven't seen a lot of, there's a few people who have sort of have nodded in this direction, but they don't really do it as a practical matter, is multi-hash chaining, where you would essentially maintain multiple simultaneous blockchains using different hashing functions
Mm,
that had to remain in consistent agreement with one another. And so when a hash went down, um,
mm,
much like striped raid back in the day,
mm.
you could recover it from the other ones and then adopt
Oh,
a
that's a good
new.
idea. Yeah, that's a good idea. So you could have, so it's like the space shuttle where they'd have four computer systems doing the same thing. So you could have like, for example, so with Ethereum, you could have like, you've got a proof of work one, and then the proof of stake one, and then you might have two other Ethereum compatible chains, and they all have to agree. Or Yeah, that's
Yeah,
actually but they use different. That could make sense, but then you can also get the problem because of the way the encryption works. Because and this is one of the someone
it's
was
yeah.
telling me about this.
That's not free. You
Yeah,
need
it's not free.
one.
Yeah.
You're multiplying the amount of work you're doing. That's not trivial. And two, you actually have to design so that these things are capable of being made compatible. I don't know if you could back it into existing designs in practical ways, um, but those sorts of thoughts and those sorts
Mm.
of approaches, I think, are going to be necessary to elevate blockchains to the point where they sort of deliver all the promises that they currently claim. They do a
Mm.
lot of what they say they do, but they don't quite do all that they say that they do.
And then you have to have the consensus mechanism has to also be secure because yeah,
Right.
and then because then there's also a problem. If you have two blockchains and they're using a different hashing mechanism, then when they do anything like say cross chain, and suddenly the whatever they're doing cross chain suddenly has to understand that there's it's talking to four different blockchains, for example.
Exactly.
Yeah,
Yeah.
and it
So
gets
yeah,
complex.
yeah. This isn't something we're gonna solve this afternoon.
Mm,
But yeah, thinking about these kinds of issues, as complexity blows up, um, is isn't free, and dealing with those complexity blowups are going to be necessary because um, systems which are too complex collapse under their own weight, and
yeah,
history has many examples of exactly that happening.
yeah, of course. Okay, so I think I've got one final question before we close off today, and that is, where do you see this whole blockchain industry and crypto and these and exchanges? Like, where do you think we'll be in 5 years' time?
Uh, I think well, the technology is obviously rapidly evolving. I think that these issues are going to be gradually addressed.
Mm,
I don't know if it's going to get cooked in the next 5 years. I think that would be a bit ambitious.
mm,
Um, but as these kind of loopholes close down and the foundations get more solid, um, I think these potentials and promises that are intrinsic in this capacity are going to become more and more real.
mm,
Um, uh, there was just a thing at the World Economic Forum that was signaling towards uh, central banks getting into blockchains. I know the Russian sanctions have now taken Russia fully off of SWIFT,
mm,
and so if if they need to generate their own or other types of systems like that, the people that I've talked to in the space, they aren't thinking specifically about figuring out how to get around sanctions to trade with Russia, but they are thinking about how to manage trade essentially off of existing proprietary trading platforms.
mm,
Um, Blockchains are a critical enabling technology if you can solve these problems, and
mm,
so there's a lot of incentive to get these problems solved. Uh,
mm.
and and uh, and so yeah, I think that could be real. Um, what I see as a bigger issue, and there's another podcast in which I had a debate with a couple of guys about this, is that the sort of current ambitions have sort of a limiting ceiling, um, whether it's tokenized contracts or just the coin systems. Um, the existing crypto space is essentially focused on kind of replicating existing business relationships into the digital space. And what I think is more important, and like CDM and other potential ideas, is recognizing that the potentials and capacities in the digital space actually point up the futility or inutility of many existing business practices, and that what's more valuable is working out how to exploit the technology that we have to replace those practices with more effective systems.
Okay, okay. I think I'm understanding the. Okay.
Because currency is a unit of measurement,
Mm,
basically. Um, the the Bitcoin people, sort of more than anybody else, are kind of like the gold bugs that basically say, a unit of measurement should have this consistent thing, and
mm,
so by making it this fixed supply, then it will become consistent. Um, but what they ignore is that currencies are units of measurement, but they're also social constructs that are part of
mm,
a culture and legal,
mm,
matrix.
mm,
Um, and you can't have one without the other.
mm,
And so developing things in that direction of creating a functioning cultural system is quite challenging if you're sort of limiting your purview to the digital space, because human beings don't live in the digital space. We live
mm,
in, the world,
mm,
and we have relationships with one another and so on. Um, so that direction of working out better ways to mediate real world relationships
mm,
through the digital space,
mm.
is of greater value. And the extent to which blockchain can facilitate that is the extent to which I think we are going to develop valuable uh, applications.
Well, I mean, don't you think that, like, for example, like with the internet, like no one says they're using TCP/IP anymore. Don't you think in 5 years that people won't even talk about blockchains? It'll just be something which is just invisible to everyone.
Um, Again, currencies tend to be more important than that. Like I've got dollar bills in my pocket and stuff like that.
Mm,
Like there's an interaction, and um, there's actually a currency that functions the way that blockchain functions, and that's the stone coins of the Isle of Yap, where
mm,
this Stone Age culture, carved these huge boulders,
mm,
basically. And because these rocks are sort of too big to move around, the family or tribal unit that originally commissioned the
mm,
rock will have it in their front yard, or like build part of their
mm,
house around it or something like that.
mm,
But the ownership of these individual coins is mutually held in the general consensus of the entire culture's knowledge.
mm,
So if I buy, kind of like a herd of sheep from you,
mm,
for my family's coin, which is, the east wall of my
mm,
house, then the two of us tell our friends that that happened.
mm,
And in a few weeks, everyone on the island knows that the east wall of my house belongs to you.
mm,
You never move it. It's
mm,
just sitting there.
mm,
But now everybody knows who owns it. And if you
mm,
decide to use it to buy something else, then, we tell everybody and everybody knows that.
mm,
Um, that is very analogous to how Bitcoin works. That the coins themselves exist within the digital space, and sort of have no independent physical reality. But since everybody knows who owns them, it's fine, because everybody knows who owns them and nobody disagrees. Um, that system was not part of a sophisticated industrial economy. So there's some interesting sort of pieces of
mm,
how those two things integrate together, uh, to function properly. But but that system was, again, a cultural construct of that community that would have been very present in their heads for how things work, just as dollars or euros or pounds or whatever are. And so, yeah, I think currencies are gonna remain residentially important
Mm.
among their user base because they pretty much always have been.
So Bitcoin, which would be classed as a currency or an asset. I think more likely an asset will still be known, but I personally think a lot of these smart contract based things, I don't think people will talk about them. I think that their value will go up a lot, but that would be because they'll be used so much more. Like, for example, look at something like USDC. So
Yeah, so
USDC,
I could see that, yeah, to the extent that we sort of work out the the functional structure of tokenized contracts like
mm,
TCP/IP
mm,
to build up a
mm,
model of contract creation
mm,
where people can kind of slap some Legos together and
mm,
get a contract rather than having to go through and code it themselves. Yeah, I think I could definitely see that being the case.
yeah.
Um, because yeah, I've been running Linux for the last 20 years, and I don't get up to my elbows in the Etsy directory nearly as often as I did
Mm,
15 years ago.
mm. Yeah, I mean, I'm on the fence about Linux because I use it. It's the most used operating system in the world for sure. Every time you use Google, you're using Linux. Um, and I used to work for Red Hat. Um, but I see that but most people, it's used a lot, and there's a lot of money made from it in consulting and selling licenses. But I don't. I think, but hardly. But if you ask people on the street which operating systems are most used in the world, and I think Linux is probably used like more than 10 to 1 compared to Windows. But everyone would say Windows is the biggest.
You're right.
Yeah, because
Yeah,
no
yeah.
one knows that there's because it's invisible,
Pe-
and I think
Yeah,
that's the
yeah.
way
You
that.
don't know that you're
Yeah,
using Windows.
yeah. I
Yeah.
think most smart contract platforms. I think you're right. It's like stable coins people will know, things like Bitcoin, or some of the major assets people will know. But I think most of it, like how it works under the hood, people won't care if they're using Ethereum or Arbitrum or Phantom. They just won't care that as long as it works. Yeah. Okay. Okay. So, is there anything else you want to add before we close off today? Like, would you like to share where people can find you and find your work, for example?
Yeah, sure. So I have a website at coordisc.com. That's COORDISC. Coordinated discovery kind of put together. You can also find me on LinkedIn at Noah Healy, NOAHHEALY. Feel free to reach out. There's also a contact email on my website someplace if you have questions or comments or anything. But yeah, the website's got the white paper and some video and some other stuff.
Okay, that sounds great. Okay, so thanks a lot, Noah, for your time today, and I hope it goes well. And I'm going to follow this project because if this works, this will be very interesting. Be very interesting indeed.
Excellent.
So thanks for your time today.
Thank you.
Thanks.